your deal? And then more importantly, how do you go from taking the working capital amount and then applying it to your specific deal? So, something very important. And I encourage you all to take that into consideration during your initial discussions with, management and so on and so forth. Number three, asset valuation overstatement. So I will caveat this. If you are pursuing asset heavy businesses, pay attention. So think, uh, transportation, manufacturing, things with large assets, which the assets are used to fuel the business operations. So I often see asset valuation overstatements in these asset heavy deals. For example, it could be equipment depreciation schedules that don't reflect actual condition or the market value. Uh, it could be real estate appraisals based on outdated comparables or inflated assumptions. It also could be hidden capital expenditure requirements disguised as minor maintenance. Uh, if you are pursuing an asset heavy type business and also an asset structure, an asset sale, if you're a buyer, which favors you in terms of tax treatment, you have to pay attention to understanding what is the actual condition of these assets being purchased and what's the market value. A few ways to kind of navigate this is getting a independent equipment appraisal. So if you're pursuing an SBA loan, the SBA will conduct its own appraisal, but more often than not, it won't be the same level of detail as someone you hired as a third party. Third party equipment appraisals are much more expensive, but if you're pursuing a multi-million dollar acquisition, a $10,000 or $20,000 equipment appraisal to reflect the true market value could save you millions of dollars. So more often than not, the asset valuation overstatement is impactful in a lot of these deals. So do keep that in mind when you're assembling your deal team and you calculate your materiality of what I need to do. My recommendation is in an asset heavy deal, a third party valuation is always assessed. This also applies to inventory. So if you have a inventory heavy business, if there's components or a manufacturing company with raw materials, you need to understand what inventory on hand is usable and then what is obsolete. Frequently, I see in letter of intents and purchase agreements that the inventory will be purchased based on the amount on hand. The thing that gets overlooked occasionally is what if you're buying goods that are on hand but aren't really sellable? So what if these goods have been sitting in the warehouse for 10 plus years and the company hasn't disposed of them because the legacy owner believes he can still sell them or figure out a way to sell them. But in reality, you may be able to sell them, but it's for significantly lesser cost. These items should be removed from your asset purchase if they really have no sellable value, or you're buying them based on the true market value of what you can sell them for today. So keep the inventory in mind and how it impacts the dollar for dollar costs of your deal. So I'm going to launch another polling question. So how confident do you feel in your ability to evaluate a business for acquisition? For those of you joining the live stream, just think to yourself, if you're actively searching, how confident are you to independently navigate and analyze your own business acquisition? Scale of 1 to 10, 10 being the best, 1 being or zero being not sure. No idea. Give you all just another minute or so. Um, all right. Most of you who selected the polling question is about a 6 or 7. So you feel confident and but you might need a little extra help to push you along in your deal. Um, that's something that I certainly, if I were to select and I do this for a living, I probably would rate myself at a 7 or an 8, just because while I'm confident in my abilities analyzing a deal, I may have a tendency to be biased if I really liked it and might overlook some of these pitfalls. So, the point of bringing in, that third party is to really ensure, you know, you're not biased in your transaction, and you're thinking about a lot of these risks the right way. So mistake number 4 is the liability underreporting and contingency blindness. So when we think about that, um, the underreporting of liabilities and contingency blindness. So the risk in specifically stock sales when you're buying, the shares of the company is there are hidden liabilities that were not disclosed before you purchase the business. So there could be tax implications, et cetera. So you need to understand what these are and how they impact your deal. I remember when I was conducting a deal, the company was not paying payroll taxes appropriately. Um, they were using 1099 employees and they were navigating around paying those payroll taxes. Um, on After the transaction closed in the first year of the new business owner operating, the IRS selected them for a payroll audit, and they ended up being fined a significant amount due to not paying payroll taxes for these 1099 employees. So this is an example of the blindness of not understanding, hidden liabilities or risks around a transaction based on how the company is operating to date. Other areas where I see liability underreporting is, the warranty reserves and customer claim provisions. If the company offers warranties based on goods sold, for example, 1 year or 2 years, uh, if that revenue is already accounted for, um, you as a new buyer could be subject to those warranties being used and having to reissue products or whatever, but not getting the benefit of that initial revenue. Um, I use the warranty as an example because this is something that will come up in a scenario like this. So a seller, you'll ask questions around the warranties. The seller will say, "Well, yes, we do offer a 1 year warranty, but it's hardly ever used." Or customer X hardly ever uses it, and for whatever reason, in the first year of business, um, you know, several customers all of a sudden now use it. So the point is, in instances where there are significant warranties, you need to understand what that looks like, why it matters, and put a contingency in place of, if we're going to reserve a portion of the purchase price in escrow to account for these warranties, et cetera. We mentioned the pending litigation. Pending litigation and regulatory costs could be significant if you don't understand them fully. So another one is the employee benefits. So if you have employee benefits such as, you know, earned bonuses that are unpaid, these are things that, you as an owner are subject to if they're unpaid, but they were earned in the prior year, and you forgot to settle these up before transaction closing. The other items are, benefit obligations or matching that is, not accounted for as expenses, but due. Understanding some of these liabilities and the risks is the key piece to making sure you're walking into a valuable deal from day one. So, you know, what is it to, I'm always asked the question, what is a typical due diligence timeline? So if you're actively searching, or if you have just joined the live stream and you have a signed letter of intent, you typically have a 60 to 90-day window to assess the company on an exclusivity basis. So the question is, I know I have to do financial diligence. I know I'm going to need a bank to get a loan. You're likely going to use a lawyer to draft the agreement or review them, at least if you're going to self-prepare them. But the question is, okay, you get the signed LOI. Now what? Should I start them all at the same time? What does the number of days look like? So this is something I will use on all of my deals, and it shows windows and time frames of what your deal should look like on a day by day basis. So typically, it's best practice in the first 30 days to conduct financial due diligence. So you'll see on day 1 through 30, you have that signed LOI. Typically, you want to conduct financial diligence and the bank underwriting process earlier on in the process to ensure if there are significant red flags found early in the process, you don't need to spend the extra money on things like legal due diligence, and if you're operational and tax diligence, if the reported incomes are materially different than what you anticipated, it's very likely the deal's not going to pencil for an SBA bank, or it's not going to pencil from a buyer standpoint if the business isn't viable based on findings around the financial diligence, such as if it's materially misstating revenue, if they're using accounting procedures that are incorrect and it materially impacts net income. Best practice is once you do have that signed letter of intent, speak with a financial diligence provider and start assembling your deal team to kick off some of these work streams. Um, moving down the chart on day 30 to 60, and again, if you have a 30-day window or a 60-day window, you can kind of squish this timeline in. But all these work streams should be performed before you do sign that final closing docs or purchase agreement. In the back half of the due diligence period, so think in the last 30 days or 45 days, you want to kick off legal due diligence, which in reality is understanding some of these hidden liabilities. You might look at the tax returns and understand tax liability. And then from there, your M&A attorney will begin drafting the purchase agreement. The purchase agreement is your binding document, which you will take and hopefully not need to use if the business materially changes after you take over the business. So your purchase agreement will contain things like reps and warranties, and other disclaimers around the non-competes, etc. Work with an M&A attorney to understand what's in the purchase agreement, why it matters, and aligning yourself with a proper attorney can really lift up your deal and protect your downside risks for, these small business deals. Um, at the conclusion of your timeline is really once you sign that business purchase agreement. So during legal due diligence, it's drafted. There may be several drafts shared amongst, the M&A attorneys from both sides of the table. So once that is finalized and signed, that is your binding document, and the transition, occurs at the time of signing. So feel free to take a picture of this and keep it as you navigate if you're actively searching. And then once you do have a signed LOI, starting to assemble these work streams and deal partners to assemble your deal team is best practice. If you have any questions around the timeline, your deal team, what it looks like, I'd be happy to answer them, and also make introductions if easier. So mistake number 5 is going to be when to walk away regardless of strategic fit. And unfortunately, walking away from a deal is painful. It's first painful financially. You've very likely, if you're walking away later in the process. So if we flip back to the chart, maybe you're walking away after financial diligence kicked off. I've seen buyers walk away right before signing that purchase agreement. Regardless of strategic fit, or if you love the deal, some of the reasons why you must walk away include things like the business cannot support the SBA loan. So an analysis I like to calculate is what is my cash flow going to look like on a weekly basis, a monthly basis at the current levels I'm buying. So if you take a look at the most recent few months of how the business is performing, you can calculate free cash flow and compare that to what your debt service payment is. In the interest rate environment we currently live in, your SBA payment on a $5 million loan is significant. So understanding if the business cannot support the SBA loan or bank loan you're taking on, you very well should either renegotiate your terms to lower the payment, or you should walk away. Walking away, again, it hurts, but is better than stepping into a business that cannot support your SBA loan, which you personally guaranteed. If the business is having sudden declines and you want to salvage the deal, what you could do is you ultimately will need to lower your SBA loan to reduce the monthly payments and yearly payments. You can push that to a larger seller note or restructuring some of the terms. Effective 6/1/25, there were certain changes around the SBA program. So review the SBA website for those few changes and how they impact the deals to date. A lot of it is specific for partial buyouts. So if you're looking to buy out 100% of a company, the new changes don't impact it a lot. But for those pursuing SBA loans, it is not a nice to have. It is required, and you need to understand the SBA current SOPs and rules in place, because those materially impact what you can afford from a buyer standpoint and the type of business you can purchase. So for those of you, actively pursuing, I'm often asked, what is a financial due diligence checklist? Do you have some sort of checklist that gives me the tools I need to send to a seller? Here are the documents I need, etc. So if you scan that QR code, this is a free financial checklist I use on all of my deals. It is clean, straightforward. and gives you the critical documents in an Excel ready or PDF ready format. Feel free to scan that QR code and you should receive a free copy. If you have any questions around the checklist, feel free to reach out to me on LinkedIn. But again, it does a nice job to cover the critical working documents you need for conducting this financial due diligence or preliminary due diligence. With that, I will conclude today's topic. I am opening the floor to questions. So if you are new to the business space, have any questions, feel free to write them in the chat. I will try to get to the chat on the Zoom presentation as well as the live stream. If you don't think of any and you have to run because you have a meeting or something else that's taken up your afternoon, feel free to reach out to me on LinkedIn, say hi anytime, and I'd be happy to meet with you, at a later date. Okay. For a new searcher, what kind of diligence will the broker and seller do on you as a buyer? That's a good question. They may, I don't think they, it's not required. They may do their own diligence by asking some questions around, just learning more about you. A lot of times during your first broker meeting, this will come up. So they'll just ask you who you are, and why it matters. Who you are, what are your business goals, etc. Um, if on the flip side, for seller due diligence, if I'm buying a business, I would like to look into who the seller is, how many businesses have they owned, what's their history, run maybe a criminal background check. Some of the, I always say buy businesses from good people, buy businesses from good sellers. If you buy a business from a seller who is deceptive and, dishonest, it could end horribly. And I've heard some horror stories about some of those areas. So just do your homework. And, typically if you buy a business from a great seller, you're going to have great success kind of moving forward. All right. Um, so two questions around warranties and warranties and unpaid bonuses in asset sales. So it depends on the warranty. If you are buying assets of the company, so in the case of warranties, if you think of a widget, if a company sells widgets, in an asset sale, you're going to be buying the inventory of those widgets, very likely. You'll have some more protection given you're not assuming the same entity. But if, in the case of the transition, if a large customer tries to, who purchases millions of widgets from you, comes to you following the conclusion of the sale and tries to redeem those warranties, you're very likely going to have to do something about it. If technically you could probably say you could take it up with the old owner, but you risk um, losing that material customer. So that's really warranties. There's much more risk if you do a liability, a stock sale, because you're assuming the new business. You're buying the shares. Um, Unpaid bonuses, again, this is something in practice should be settled prior to closing. Um, Similar situation. If you buy the assets of a company in an asset sale, and on day one, the employee, one of your main primary employees, comes to you and says, I was never paid on my annual bonus from last year. You need to pay me or I'm quitting. To them, it doesn't make a difference what your transaction is structured as. Stock sale, asset sale, it doesn't really matter to them. What matters is someone needs to pay them for their bonus. So the point of it and why I bring up warranties and unpaid bonuses is ensure these things are identified and settled prior to closing. So bonuses that are earned but unpaid should be paid out during the transaction change of hands. And if they are not, they should be used as a dollar for dollar reduction to the total purchase price. So those are two mechanics of how you treat both of those. Again, depending on the business and the materiality of it, work with a financial accountant and your M&A attorney to best navigate those two issues. Couple questions we had from our live stream chat. Can you flip back to the timeline? So as mentioned, the due diligence timeline, feel free to take a screenshot or snippet from your computer. This timeline does a nice job of showing what's needed at each phase of the transaction. So days 1 through 30, 30 through 60, etc., and the deal team components, financial diligence, legal and tax due diligence, and of course, the bank, whether it be a traditional bank or an SBA bank. Um, if you need a copy of this, and feel free to reach out to me on LinkedIn or Twitter. I'd be happy to share one with you. You can also find this in my business buyers toolkit, which is a free guide. I think it's up to 60 or 70 pages of all the templates I use. So you'll have the checklist, you'll have this timeline in it, you'll have the difference between the asset and stock sale. If you go to my X account, SMB Deal Guy, and you click on the pinned post, you can receive a copy of the full guide for yours to keep forever. Sent automatically to you once you fill out the form. Let's see. What else? Have time for two more questions, and then we'll be heading out. Someone asked in the chat, what should I think about when I am, not under LOI yet, but I am actively speaking with business owners, and I want to just understand like the key findings, like what's important before I submit an LOI. So what I like to do is try to get as much information as possible So you ask for the bank statements, or no, you ask for the preliminary financials, the latest financials. So we're almost in July 1st, 2025. At this point, it is appropriate to ask for a complete year of 2024 finalized, as well as 2025 numbers. You as a prospective business buyer, your primary concern is how the business is performing in the last 18 to 24 months. Really, it's the trailing 12 months, because this is the business you're buying. So the trailing 12 months includes, almost 6 months of 2025 and then 6 months of 24. Push brokers to give you some glimpse of these numbers. They're going to say very likely that, the numbers aren't final, but just get an understanding of, how is the business performing? Are revenues in line with last year? Are they significantly more? Which is great. That means you could pay more. Are they significantly less? Okay. It could be an issue, but it's better to know now than during underwriting or after due diligence, because then you're going to have broken deals. Your bid for $5 million is probably going to be worth $3 million. So understanding, what is material during that initial phase. And I'll go back to, the timeline of where it matters. So a lot of you are going to fall in this initial discussions. You're speaking with sellers. You're getting excited. You're looking at a lot of deals. This is when you ask those preliminary questions, which may save you a lot of time. The letter of intent is taking your fact finding during those initial discussions and putting together terms of how much am I going to offer to buy the business for? Let's say it's for $5 million. How is that $5 million going to be paid? Is it going to be paid $5 million cash? Probably not. It's probably going to be 90% cash, which is acquired through a loan, maybe 10% seller note. Is it going to be 80% cash and 20% seller note? These are the conversations you have in the LOI phase. Again, an LOI it's non-binding, but if you're a active business buyer, I would consider it, your LOI as almost like a resume for a job. Ensure it's polished, have it be thoughtful, because it is a representation of what you as a buyer stand behind. If your LOI is rushed, if there are grammar issues, it may paint a poor picture of you, which might not be actually true. So just take the time to be thoughtful around your LOI and when you're submitting them, because it is a representation of yourself as a buyer. Brokers and sellers will take you more seriously if it's very neat and polished, and they will take you less seriously if it's not. So that's something I've seen in practice. Small business acquisitions, especially the ETA space, is much smaller than you actually would think. Brokers speak to each other. You may see a few of the same brokers represent many companies. So you want to be on their good side, and you want to paint yourself as a serious buyer with the intent to close, not a tire kicker. Just something to think about kind of going forward. One last question I'll take before we break is, when should I speak to a financial due diligence partner? So in the initial discussions, you can engage with some financial diligence partners to do preliminary diligence. More often than not, once you have that signed letter of intent, it is appropriate to reach out and kick off your formal due diligence. So it's typically a 3 to 4 week process, which is a full-time intensive analysis of the business. what is the quality of revenue? What are the quality of earnings? Uh, if you're actively, you know, looking at businesses and you're looking to make introductions, I lead a small financial due diligence practice focused on acquisition entrepreneurs. So I'd love to meet with you and at least say hi and learn more about your buy box, what your timeline looks like. So feel free to scan that QR code. It should jump to my LinkedIn or my meeting calendar, and I'd be happy to meet with you. Um, with that, if you have any questions around the checklist, how to get started, what are next steps, feel free to reach out to me on LinkedIn. With that, I really appreciate you all joining today's webinar. For those of you on the live stream, if you have any questions or feedback around how it performed, I'd love to hear from you. Feedback is a gift. And as I continue this 2025 acquisition and business sale webinar series and live stream series, I'd love to continue finding ways to improve the content and really deliver the most value for those of you who tune in. So appreciate you all for joining, and I will see you on the next one.